Breaking news. We are seeing the same market signals that we saw in 2001 during the dot com bubble, in 2007 during the great financial crisis, and during the market top in 2022. Financial markets are repeating their market top patterns. This could reverse the uptrend and it could catch investors by surprise. Is this time different or will history rhyme? Can stock indexes and Bitcoin hit new all time highs? Will we have an alt season or are we going to break the 4-year crypto cycle and fall into a market crash? Hello, my name is Kyle, and I don't want to make this a video, but we've been seeing recession indicators start to trigger. And the recent market structure and turmoil looks more like a market top than it does just a small correction. And I'm going to show you in this video the evidence that this is a market top or we're close to a market top. Some pieces here that I don't think you're going to see or find anywhere else. We're going to look at two different scenarios that will most likely play out. And we're also going to talk a little bit about the crypto cycle. What usually happens is markets and risk on assets top first, and then a recession comes. But recession indicators are easier to decipher than market top indicators. And that's just because markets are more liquid and they kind of predict the future, if you will. Now, in the recession category, we've had a couple trigger. The first I want to talk about is the SAM rule. Real quick, before the SAM rule, I want to let you know my free newsletter subscribers got this information on August 20th when the S&P was near its all-time highs and Bitcoin was at 60K. They got a head start on this information, and you can too. There's no reason not to. Completely free. Newsletter link is in the description. And the SAM recession rule is a rule that is based on unemployment. And unemployment is important because if people aren't employed, they can't spend money in a consumer-driven economy. And our GDP is highly driven by consumption. Now, the SAM recession rule triggered on August 2nd. It's a very simple indicator that says when the 3-month average of unemployment rises by 0.5% or more, we are actually in a recession, and that is already triggered according to the indicator. Now you might say, okay, great, but how accurate is this indicator? This indicator has tripped during all 11 recessions since 1950, but there was one exception. That was in 1959. The rule triggered, but 6 months later, we were actually in a recession. Now, as investors, we know that we can't make decisions based off of one indicator, even if it is extremely reliable. The next indicator I want to talk about is the yield curve and the yield curve inversion. Now, the yield curve is just the 10-year yield minus the 2-year yield. So you just take the percentages and you subtract them, 10 minus the 2. When that goes negative, that is a sign that there is a recession in the future. Now, generally, the recession doesn't begin until 1 to 12 months after the yield curve uninverts or becomes positive again. And the duration of that inversion, or the amount of time that it's negative, is an indication of how likely it is for a recession to occur. Now, there's only been one false positive of the yield curve since 1950. And I would say that's a pretty reliable recession indicator. Now, if you take a look at the yield curve today, the yield curve has uninverted as of yesterday, September 4th. So once again, we have two extremely reliable recession indicators that have already triggered. Now, I don't think we're necessarily in a recession today, although GDP data can be revised down in the future. But with these two indicators triggering, we have to be close. Now, there are other recession indicators that we're not going to get into, but you see the same weakness in other parts of the economy that we saw, in 2007 and 2001, namely in housing, also in consumer spending, and also in manufacturing. The Chicago PMI actually hit one of the worst readings it has hit since 2009. Now that we've covered why there's fairly high confidence that a recession is in the future, let's look at the market tops and kind of how markets top. Now, what you'll notice is markets usually top before recessions, so you can't generally wait for recession indicators, otherwise you would be late to the party. And also, you'll notice there's a double top pattern that's happened all the way back to 2001. So let's take a look beginning in 2001. We're also going to look at the S&P because we just have more history with stocks. And since crypto hasn't seen a ton of recessions, the patterns aren't going to be as obvious. So each of these markets in 2000, 2007, and 2022, they saw a double top, and they all had this correctional pre-crash pattern. So the double top in 2000, it starts here, it looks like right around in April, and then that's the first top, and then we chop around a little bit, and then we finish the top out here. I believe that's in November, that's the second top, and from there, the S&P declines, and shortly thereafter in 2001, the spring of 2001, we enter the recession. Now let's look at what happened in 2007, right before the great financial crisis. Now you'll notice we have the pre-crash correction again. That happened in early 2007, and then we go up to our first top here in around, I think that is August 2007. We chop around a little bit, we decline, chop around a little bit, there's a little bit of fear in the market, and then we top again. Our second top hits, I believe that's October of 2007. And from there, we quickly enter a recession. I think it's only a couple months later in December of 2007 that we enter the recession, and markets decline pretty much all the way through the recession into the great financial crisis. So you might say 2 is a coincidence, but 3 is definitely a pattern. In 2022, we didn't see an official recession, technical recession, you might call it, because we did see 2 negative quarters of GDP growth. But we got a pre-crash again on the S&P, and then we had a market top. It was a double top. We got a little bit of extension at the end here, but for all intents and purposes, this is the same structure we've seen the last 2 cycles. So we've identified the patterns of market tops in the last couple of business cycles in equities, but you might be saying, like, that's great, but how do we know this just isn't a correction that's going to lead to all-time highs in the future? And that's where I identified a pattern in the VIX that occurs during every market top, especially the ones preceding recessions. And I want to show you that right now so you can see it too. So this pattern in the VIX is telling about where we are in the market top. Now what you'll notice here in 2000, this is the dot-com bubble again, we have the pre-crash, and what I want you to look at is the VIX. Now, it's very tough to see here back in 2000, 2001, because there's not as much data, intraday data as there is today. But you can kind of see these green dots, and these are the daily data points of the VIX. And what you'll notice is the VIX makes lower lows all the way up until we get to that top region. And right after we get to that top region, the VIX begins to make higher lows. Now, you might say, like, why is that? And I think, all you have to do is think a little bit about psychology. What it's telling me is that some market participants understand that there's underlying issues in financial markets. That's saying basically that people, a small subset of people, are trading in such a fashion that they're increasing the VIX. And when these market participants start selling more, you end up with like some bigger swings in equities, right? And that would cause the VIX to increase. Now, this didn't just happen once. Now let's look at the great financial crisis, and let's look at the VIX once again. See, we get our pre-crash, and right before the pre-crash, the VIX is making lower lows. And it's important to look at the lows because this kind of tells you, where the bottom is in fear. Now, right after the pre-crash, market participants started identifying that there was some weakness in the market, and the VIX starts making higher lows. Now, if you look at the structure of the VIX, what I think is really interesting is between that bottom VIX, when it was making lower lows, and that first little bump higher, its second set of higher lows here after that pre-crash, that's about a 20% higher on the VIX, between the lowest lows and then the higher lows that it made after that little pre-crash. For timely market updates, hit the subscribe button and make sure you select all so you don't miss any critical news. Now, the great financial crisis isn't the last time we saw this structure in the VIX and the market top. We see it once again in 2022. You see the VIX making lower lows here as the S&P is running up. Then we had the pre-crash, and we hit the lowest level that the VIX sees during this top. Now, right afterwards, we get that double top with a little choppiness in the middle there, and what do we see with the VIX? 15% higher lows. Well, would you guess what we're seeing right now? That's right. We're seeing higher lows in the VIX once again. So here we are on a chart with the S&P today in red and the VIX in candles. And what I want you to notice is we bottomed out here on the VIX around 11.9 or 12. And then we had the Japan carry trade unwind. We had a 10% decrease in the S&P just about, and a 15% decrease in the NASDAQ. Bitcoin hit around 48,000. And we had that spike in the VIX, and that's the third largest spike of all times in the VIX. It's pretty significant. But what I want you to notice is we recovered from that. The S&P got back up to its previous all-time highs, more or less. But the VIX has not hit new all-time lows. We are at that, looks like 19 to 20% mark on the new base of lows there. We never got back down to that 12 on the VIX. And what that tells me is there's some smart money out there. There's some market participants that see foundational cracks in the market. Now, whether we're at the pre-crash position in this market or we are at the double top, I don't know for sure. But what I can say is, based on the structure of the VIX here, somebody in the market knows that things just aren't right. I want to show you what I mean when I say the market knows that there's systematic risk in the financial markets. Let's look back at 2007 real quick at this Wall Street Journal article. They said that the market crisis started weeks ago. Keep in mind, this is August 16th, in the middle, at the bottom in the Valley of Optimism. Say the market crisis started weeks ago with problems in troubled securities, especially those backed by subprime mortgages, and that's what caused the 2027 great financial crisis. That snowballed into everything that occurred, all the financial trouble and all of the blow-ups that occurred within banks and different lenders. Now I want to look at the catalyst that got us from the bottom of the Valley of Optimism up to our second peak in 2007. And that was when the Fed cut its discount rates. Now this was the overnight lending rate, but it was the catalyst that got us back to that second top. The Wall Street Journal reported the Fed Friday morning cut its discount rate to 5.75 from 6.25, offering cash-strapped banks and lenders a safety valve and lending a psychological boost to nervous markets. Now this is important because this is the day after the last article and right after the bottom of the Valley of Optimism in 2007. A couple months later, we hit that second top based on this catalyst and the Fed starting to ease, and then it was all downhill from there, if you will. Now, what I want you to understand from those journal articles is that market participants knew that there were risks in the market, but some market participants understood that there were significant cracks in the foundation. For example, Michael Berry, or you watch the Big Short, and you see that some people understood how serious the subprime mortgage crisis was going to be. Now, what did we have recently? We had the Japan carry trade, and if you follow the Japan carry trade, you'd say, "Hey, Kyle, that's a great concept and all, great theory." But J.P. Morgan came out and they said 75% of the carry trade has been unwound, and I would say, "Hey, yeah, you're correct." But I'd also say, have you seen the Charles Schwab article that said the short-term carry trade has probably unwound, but there's a medium and long-term carry trade that could take a little bit longer to unwind? And do you know how much money is estimated to be in the medium and long-term carry trades? $4 trillion. Do you think that could have an impact on markets? It most likely will. Now, whether the Japan carry trades ends up being the catalyst that brings us down markets, we don't know, but unemployment trends alone could bring down markets. If you study unemployment, just for a couple of minutes, you'll see when unemployment starts to accelerate to the upside, we usually don't see that stopping until we hit a recession. Many of you will also rightfully tell me that crypto has a 4-year cycle. And if we were to see a market top in the next couple months, we would break that 4-year crypto cycle. And I am a believer in the 4-year crypto cycle, believe it or not. You see that pattern occur again and again. You can't deny it. But crypto is not going to perform well in a bad economy. You see, the economy needs to be good to provide individuals, consumers, and businesses with enough cash to make investments into crypto. And if consumers don't have money because they're getting laid off, if consumers don't have money because they're not working as many hours as they used to, if consumer debts are high, which they are extremely high, hitting new highs, they don't have the money to either buy products from businesses or invest extra money into crypto. And even if industrial and enterprise companies, businesses start investing more in crypto, that is going to be capped off by the fact that they have services and products that they need to sell to consumers as well. And if consumers aren't buying, they need to liquidate investments. And what are they going to liquidate? They're going to liquidate stocks, crypto, and any other liquid investments that they have that they can easily sell to put back into cash on their balance sheets. So like I said at the beginning of this video, there are two scenarios that I see playing out. And this could be scenario one, which is the most bullish scenario, where we are just in a pre-crash right now. We've seen that VIX elevate, and we're going to push to new time highs. I've drawn out a chart of what that might look like. And what we'd have to do is we would have to break these previous all-time highs that we had around 56.70 on the S&P 500. I think if we do break that, my target is right around 6,050 based on fib levels, and something we can confirm with the RSI resistance, which we might be able to get into later in another video. I hope this is the scenario. It would give a chance for us to see, maybe an abbreviated small alt season, and it would also give us a chance to see a new Bitcoin all-time high. But, there's no promise we see this, and actually, I'm concerned that we're going to be in scenario 2, which I'll show you here. Now, this is scenario 2, and I think this scenario is unfortunately more likely. I mean, I'm only like 60-40 on the two scenarios, but I do favor this one. Now, there's two ways we could double top here. We could have double topped right the last couple of days here, and we could be heading down with a bounce in the future. Or we can kind of chop around here. We might see the Fed cutting interest rates as a second catalyst to push us back either to a new all-time high or another little top here. But either way, I'm confident that we're either in the pre-crash or valley of optimism, and I am making my exit strategy accordingly. If you would like more in-depth market top analysis, including my crypto exit strategies, you can become a Market Navigator member of my crypto channel, and I'll also be including some picks for the bear market and rate cut environments, which are already in the green. Now, if you're a huge fan of the channel, you can become a Crypto Crusader, where I will include one free project review at your request, and that's the deep dives that I do in my channel. Go look at them. I look in depth at the team, tokenomics, product market fit within the greater crypto market, and these usually take me 4 to 8 hours minimum. That's for $44.99. I think it's a great deal, and if you're interested in that, we'd love to have you as a member.